Somewhere right now, a person types a question into a chat box, and 3 seconds later, a complete answer appears. It feels free. It feels instant. It feels like magic, conjured out of nothing. And that feeling is the most expensive illusion in modern business. Behind that single answer sits a machine that has already spent more money than most countries raise in taxes in a year. The five largest technology companies on Earth are on pace to spend over $700 billion this year alone, just building the physical plumbing behind that chat box. The chips, the buildings, the power lines, the cooling systems, and the company that generated the answer you just read almost certainly lost money doing it. One of the most famous AI labs in the world posted a net loss of over $38 billion in a single year, even while its revenue nearly tripled. Another well-funded AI company collapsed into bankruptcy so fast that its customers lost access to their own data overnight. So here is the question this documentary is going to answer. If the smartest investors in the world are pouring more money into this industry than into almost anything in financial history, who is actually getting rich from it? Because the answer is not who you think. The public fantasy is simple. Buy the chips, build the data center, rent it out to an AI company. Watch the money come in, because everyone is using AI now. It looks like the cleanest business model of the decade, a landlord business for the 21st century. And for a narrow slice of the industry, that fantasy is real. The company that makes the chips powering almost this entire build-out is sitting on gross margins above 70%, with data center revenue crossing $115 billion in a single year, up over 140% from the year before. But the deeper you go, the stranger the picture becomes. The company selling the shovels is thriving. Almost everyone else digging for gold is either barely surviving or losing money at a scale that would bankrupt a normal business in a single quarter. Start with what it actually costs to get in. A standard data center shell runs $10 to $12 million per megawatt to build. But an AI-optimized facility needs specialized liquid cooling and reinforced power distribution, because these chips draw far more power and generate far more heat than anything before them. Fully loaded, that cost climbs toward $30 to $40 million per megawatt. Researchers modeling a full 1 gigawatt AI campus put the total upfront capital requirement at roughly $38 billion for one facility. And the building is often the smaller problem. A single high-end AI chip costs roughly $3,000 to manufacture and sells for over $30,000, a margin so wide it explains why the chip maker's profits are the envy of the industry. Two major tech companies each bought around 150,000 of an earlier generation of these chips in a single year for $4.5 billion each on chips alone before a single customer was signed. Now follow the money the other way. Enterprise customers pay monthly subscriptions. Developers pay per unit of computation through an API. And underneath both of those, a third, larger stream, the cloud giants themselves, who don't sell AI answers to the public at all. They sell raw computing capacity by the hour to the AI labs that do. That's the revenue stream most viewers never think about. The businesses making the most reliable money in this industry are frequently not the companies whose logos appear on your screen. They're the landlords renting the machines underneath. Now the cost machine, and this is where the fantasy usually dies. One leading AI lab generated just over $13 billion in revenue in a recent year. Its total costs reached $34 billion. Research and development spending alone exceeded its entire revenue. The result, an operating loss of nearly $21 billion. Its gross margin, what's left after only the direct cost of serving each customer, sat at 33%, down from 40% the year before, because the cost of answering each question quadrupled in 12 months. A rival lab reported a cleaner 40% margin, but once you add the ongoing cost of training and maintaining the models, a cost that never stops, that margin flips negative. Impressive revenue and genuine profit in this industry are barely on speaking terms. Which brings us to the first hidden killer, depreciation. A normal industrial asset lasts 10-15 years. A modern AI chip is functionally obsolete within 18 months to 3 years because the next generation runs cheaper and customers migrate almost immediately. Facilities built only 2 years ago are already being written down by as much as 40% below book value. A deal that looks profitable on a comfortable 10-year model can turn deeply unprofitable the moment you accept the honest 3-year reality of how fast this hardware ages. The wider industry is now moving through a very recognizable cycle. Extraordinary demand triggered confident spending. Confident spending triggered cheap financing. Cheap financing triggered a construction boom so aggressive that equipment-led times have stretched into years. And now that boom is triggering the next phase. Banks pulling back from funding new projects, dozens of announced data centers quietly canceled or delayed within weeks. One respected research institute predicts half of all announced mega facilities will never actually get built. Legal analysts tracking the sector estimate the entire AI industry brought in roughly $60 billion in revenue in one recent year, against roughly $400 billion in capital expenditure in that same period. The revenue is not close to catching the spending, and the electricity bill is fixed whether or not the tenant renting the building is paying its rent. To see what happens when that imbalance breaks a company, look at one well-funded AI software company that collapsed in a single week. At its peak, it was valued at over $1 billion, having raised over $400 million in venture capital. It had claimed roughly $220 million in annual revenue. When auditors finally looked closely, the real figure was closer to $55 million, a gap of roughly 75% between the story and the reality. By the time it collapsed, it had only around $5 million left in the bank. A lender seized $37 million directly from its operating accounts within days. Customer applications went offline almost immediately, taking their data down with them because nobody had negotiated protection for exactly this scenario. It owed $85 million to one major cloud provider and $30 million to another. No single decision caused it. Overstated revenue hid the true cash position. Aggressive spending continued under a growth story even as the numbers deteriorated. And when it finally broke, there was no cushion left to absorb it. That collapse points to the second hidden killer: customer concentration. A huge share of new AI data center capacity is being built for a single anchor tenant under a single long-term contract. Much of that debt has been packaged and resold to a wider pool of investors, the same structure that amplified losses in the 2008 financial crisis. If that one tenant defaults, the damage doesn't stay contained. Large operators can absorb losing one struggling tenant. A smaller, independent operator that borrowed heavily for one anchor tenant may not survive that tenant walking away. What genuinely improves at scale? Better prices on chips and power, cheaper financing, long-term power agreements that smaller players can't negotiate. What gets more dangerous? Debt loads now measured in the hundreds of billions, and circular financing arrangements, a chip maker investing in an AI lab, which spends that money buying chips from the same chip maker, creating the appearance of demand without necessarily creating new revenue. 3 honest scenarios for a mid-sized operator building a 30-megawatt facility for roughly $300 million. Optimistic: a strong tenant, high utilization, conservative 4-year depreciation, operating profit around 18 to 20%, a genuinely healthy margin. Realistic: rising electricity costs, one contract renegotiated downward, equipment arriving a year late, operating profit compresses to 5 to 8%, thin enough that one more shock erases it. Downside: no single disaster, just 3 ordinary risks landing in the same window. A tenant renegotiating to protect its own margins, a new chip generation making the current fleet uncompetitive, and financing costs rising as lenders reprice the sector. On paper, the facility still shows revenue. In practice, debt service consumes it, and the operator ends up negotiating with lenders instead of customers. The operators who survive understand something the fantasy never mentions. They diversify their tenant base instead of chasing one prestigious anchor contract. They price contracts around the true 3-year decay curve of the hardware, not a comfortable 10-year fiction. They keep real cash reserves for the failures that are now a statistical certainty in this sector. The data center is not the real business. The real business is the contract behind it and the tenant's actual ability to pay, because a beautiful, fully powered building generating 0 rent isn't an asset. It's a $300 million liability with excellent air conditioning. So who actually gets rich? The chip maker sits at the top, margins above 70%. A customer base so desperate for supply, it's effectively financing its own demand. The cloud landlords hold the second strongest position, collecting contracted revenue regardless of whether their tenant ever turns a profit. The AI labs building the products you actually use sit in the most exposed position, the highest brand recognition, and in several of the largest cases, the deepest losses. Independent operators without hyperscale backing sit in the most fragile position of all. And the people typing questions into a chat box sit, for now, in the best position anyone occupies, because a price war between well-funded cash-burning labs has kept consumer prices artificially low, a subsidy paid almost entirely by investor capital, not genuine profit. So, return to the fantasy this story opened with. Buy the chips, build the data center, get rich. The honest verdict? This industry can generate serious wealth, but overwhelmingly for whoever controls scarcity, not whoever controls visible infrastructure. The building is not the real business. The chip is not the real business. Even the answer on your screen is not the real business. The real business